Hey everybody, this is John the Quant. Welcome to this very first super fast course. I hope to make more of these. This one is about interest rate swaps, and the purpose of a super fast course is to try to pack as much information as possible into a very short amount of time. So this one's about 2 hours total. And it's supposed to take you from knowing almost nothing about interest rate swaps to kind of understanding how they work in the market, what you might use them for, risk management, hedging, things like that. And then we go a bit into the math. It's not very hard math, but we're going to learn how to price them and how to value them. And then we'll talk a little bit about variations on what's normal. And that's it. Takes about 2 hours. Links to each chapter are in the course. And remember, this goes really fast. It is a lot of information. So don't be afraid to pause, to rewind, to come back and rewatch later, or just to, step out for a bit if you need to. All right, let's go. Well, the important word here is swap. So swap implies that something is being exchanged, and interest rate swap implies that the thing being exchanged is interest rates. But what we're really exchanging is a pair of commitments. So both parties in an interest rate swap are committing to making payments to the other party, with the payments based on an interest rate. And they commit to making payments based on specific rates at specific frequencies with a specific underlying notional value, and they commit to making those payments a specific number of times. So there's a lot of specifics in there, which means that interest rate swaps tend to be negotiated over the counter. Each contract is really customized to meet the specific needs of the specific parties in the transaction. And there is some standardization. For example, the International Swaps and Derivatives Association has devised some standardized contracts that mostly take care of legal issues in order to expedite the process. But the standardizations don't cover the economic issues. And the economic terms of the arrangement are really what we care about. So let's go ahead and define those. First, the parties are going to need to agree on the type of swap. In our case, it's going to be an interest rate swap. So at least one of the two payments is going to be based on some kind of interest rate. Then they'll need to agree to the term, the tenor, or the maturity. All those words mean the same thing, and they basically talk about how long the swap lasts. Now, interest rate swaps tend to be long-term agreements. They might have, a maturity of 10 years or 30 years or 50 years or even 100 years. That's not entirely unheard of. They'll need to agree on a settlement frequency, which is how often they're going to make payments to each other. Most commonly, it's going to be quarterly or maybe semi-annual, every 6 months, but it could be less or more often. They'll need to agree on the actual interest rates, okay, because the payments are going to be based on those interest rates. In general, one side or leg is going to be based on a fixed rate, and the other side or leg is going to be based on some index rate, which does change over time. Now, they'll need to agree to a notional value. And this is the size of the contract. It really just scales the payment. So for example, if one party commits to making annual 5% payments on a notional value of $100 million, then that party is going to be paying $5 million a year. Or if they agree to make annual 5% payments on a notional value of $150 million, then they're going to be paying $7.5 million every year. So you can see the notional value scales those payments, and interest rate swaps tend to have pretty high notional values. 100 million, 150 million, the numbers I've just been saying, those are pretty common numbers. So they do end up being really big contracts. And when you're dealing with numbers that big, you need to be really careful with your calculations, because even a few decimal points can really change everything. Now we call it the notional value, okay, notional, because that money never actually changes hands. It is just there to size the payments. In our example before, nobody ever pays anybody $100 million, and nobody's actually paying $150 million. That number is just being used to calculate the actual interest payments. And because we never exchange notional values, interest rate swaps can be really capital efficient, very capital efficient. And what we'll see is that if we balance the legs of the swap properly, there is most often no upfront cost to either party. I said leg a few times there. So what is a leg? Well, it's a side of the deal. Typically, one side or leg is going to pay a fixed rate and the other leg is going to pay a floating rate. We're going to call them the fixed leg and the floating leg. We also need to define the setting date or the reset date, and this is going to be the day when the floating rate is set, and it's generally a couple of days before the start of the interest period, which is called the effective date. Okay, the effective date is the day when the interest rate period actually starts. For example, I know this is a lot of terminology, so let's do an example here. Say we are on the floating leg of the swap, and we've committed to paying the LIBOR rate, okay, that's the London Interbank Offered Rate, every 6 months. And let's say that the next payment is due on January 1st of next year. So the effective date is going to be July 1st, that's 6 months before the payment date, but the setting date is actually going to be on, say, June 28th, a couple of days before that. And we do it this way so that on the effective date, the party on the floating leg already knows what their next payment is going to be. And this both it helps deal with risk because, like I said, we would know what our floating rate payment was going to be 6 months in advance so we can make preparations. But it also makes pricing interest rate swaps much, much easier. And we're going to see how that works out later in the course. Last bit of terminology we need is the trade date, which is just the date of the transaction when the swap actually goes into effect. So, in an interest rate, parties are, mechanically speaking, they're exchanging payments based on an interest rate. That's what they actually do. But in a more financial and theoretical sense, the real purpose behind an interest rate swap is that the parties get to exchange exposure to interest rate risk. And this makes interest rate swaps great for risk management, but we're entering into a commitment with another party, and they're usually commitments to making big payments, at certain frequencies a lot of the time. Sometimes it's even a variable payment if the other party's on the floating leg. So the main risk in an interest rate swap is really going to be counterparty risk. Okay, that's the risk that the other party doesn't uphold their end. It's the risk that they don't make their payments. So counterparty risk used to be a big deal when entering into a swap, but the swap market underwent some big changes after that 2008 financial crisis, and new U.S. regulations were imposed. And now in the U.S., all the swaps have to go through a clearinghouse, kind of like futures or options. And this actually seems to be a big positive for swaps, okay, because the use of clearinghouses drastically reduces counterparty risk, and it makes swaps more liquid. So the swap market has actually overtaken most, if not all, other markets at this point. It is enormous, very, very liquid. And we're going to talk about all that stuff more, especially later on in our chapter on clearinghouses. In this chapter, we are going to define and understand the most common form of interest rate swap. That's why we call it vanilla. It is a fixed for floating swap, meaning one leg is based on a fixed interest rate and the other leg is based on a floating interest rate that changes over time. So let's go ahead and draw this example. We're going to have two parties. We're going to call this one B, and this one over here will be A. And these could be corporations, or they could be hedge funds, maybe government entities, asset managers, or swap dealers. And often one of the two parties is a swap dealer. Now B is going to pay A based on some floating interest rate that changes over time, and A is going to pay B based on some fixed interest rate over time. So B is paying the floating rate. He is on the floating leg, and A is paying the fixed rate, or the fixed leg. Now, every payment that A makes to B is going to be the same amount. A is on the fixed leg. Every payment is the same. Now, the floating rate will usually be based on some index. So let's write out a few. Floating rate is going to be based on an index. This could be, it could be, say, 1-year T-bills, or it could be the Fed funds rate, or it could be the prime rate. But most often, this is actually LIBOR, the London Interbank Offered Rate. And generally, the version of the floating rate corresponds to payment frequency. So if we were making, say, quarterly payments, we would probably use 3-month LIBOR. And if we were making semi-annual payments, we would probably use 6-month LIBOR. Now, most often, the floating leg rate is equal to the interest rate. So in, say, this example with semi-annual payments and 6-month LIBOR, we would literally pay 6-month LIBOR, and the fixed rate is calculated such that the initial cost of the contract is 0. We're going to talk about how to do that later. Now, to define the cash flows and see an example, we've got to talk about day count conventions. And because notional values are so high, we need to be super careful when calculating cash flows, as small mistakes can generate large risk-free losses, which is like arbitrage against us. And it's easy to get confused by day count conventions. And there's really 3 big, well-known conventions. And the first is the oldest. It's really more of a relic from the days before calculators, when people had to do all of this multiplication and division by hand. And this convention is, I'm going to call it the old convention. It probably has a name, but I don't know it. I'm going to call it the old convention. All right, and we'll assume that a month has 30 days and that a year has 360 days. So that way, every month is 30 over 360, or 1/12 of the year. Now, we know that this is not true. We know that February has 28 days, and a few months even have 31 days, but it makes the math easier when you're doing it by hand, and people still use it sometimes, so we should be aware of it. And the other day count conventions come from money markets. So in the US, the convention is really to use the actual number of days in a month, but still to say that the year has 360 days. Okay, so in that case, we're going to call this actual over 360. And in the UK, they also say that we should count the actual days in a month, but they assume that a year has 365 days. So we'll call this actual over 365. And you've got to be able to check the day counts. Make sure that you're using the right day count convention when you're calculating payments, or you can mess this up really bad and it can get really expensive really fast. So now let's go forward and we'll do an example of some cash flows. So let's draw our swap again. B is making floating payments to A, and A is making fixed payments to B. And now let's draw a timeline here for the payments. Now right here, this is the trade date. And we're also going to say that it is the setting date and the effective date, just to make everything much easier. And then in between here, and this we'll call big T sub n, that's the end date, all right, when the swap ends. In between those two, we're going to have a whole bunch of payment days. We're going to say T1, T1, T2, T3, and so on, all the way up to Tn. So on each of those T's, A is going to pay B based on a fixed rate. So it's going to be the notional value times the fixed rate times the day count convention. And at the same time, B is going to pay A the notional value times the floating rate, which, remember, came from the beginning of the interest rate period way back when. So at T2, he was paying the floating rate from T1 and so on. And of course, they also multiplied that by the day count convention. And it is not uncommon for these to be different conventions. So we really do need to be careful all the time. Although really, payment is going to be netted. They're not both going to make the full payment to each other. What's going to happen is they'll calculate both payments, and then if the fixed leg payment is greater than the floating leg payment, then A will pay B the difference. And otherwise, if the floating leg is greater than the fixed leg payment, then B will pay A the difference. Now let's do an example with actual numbers in it, shall we? So right here, we're going to redraw it. This is A, here's B. B is paying the floating, and A is paying the fixed. And let's say here that the fixed rate is 1.58%. The floating rate for this time period was 0.26%. The notional value is going to be $100 million. And our day count conventions here for the fixed rate, we're going to use the old style, 30 over 360. For the floating rate, we're going to use the UK style, actual over 365. And we're actually making semi-annual payments here. And never mind, let's make quarterly payments. To make it a little easier, quarterly payments. So in that case, the fixed leg payment is going to be the notional value, that's 100 million, times the fixed leg rate, which is 0.0158, and then times the day count convention. It's quarterly, so that's 3 months. 3 times 30 is 90 days, and a year has 360 days in it. So if we do that math, pull out a calculator, 100 million times 0.0158 times 90 divided by 360, that fixed leg payment is going to be $395,000. Now for the floating leg, we're doing a very similar thing. We're going to take that $100 million, multiply it by 0.0026. Okay, that's our floating leg. And our day count convention is actual over 365. So between January 1st to April 1st, there's actually 90 days. So that kind of lucked out for us. So we have 90 over 365. Go count them if you don't think there's 90 days. I'm pretty sure there is. So we'll multiply that. 100 million times 0.0026 times 90 divided by 365 to get that the floating leg payment is $64,109.59. So in this one, the fixed leg is greater than the floating leg. The fixed leg payment is greater than the floating leg payment. So A will pay B the difference, which is $395,000 minus $64,109.59. A is going to pay B $330,000, 330,890.41, $330,890.41. This chapter is about the actual process of interest rate swaps, from starting negotiation to making the final settlement. So, first, recall that a bunch of terms of the swap are negotiated. So for our first step, a client and a dealer have to negotiate. And that's step one, negotiate. Once they've agreed to all of the terms of the swap, they've agreed to the notional value and to the payment frequency and to the term or tenor and what interest rates will be used and so on, the dealer is going to give that information to a clearinghouse. This is called the affirmation point. And here, in step 2, the dealer is going to give the swap to a clearinghouse. Basically, what that means is the dealer is going to let the clearinghouse know all of the terms that they have agreed to. Then the clearinghouse is going to check with the client to affirm that those are, in fact, the terms of the deal that they agreed to. Affirmation is step 3. Now, in step 4, the swap is officially introduced to the trading house, clearinghouse. So right here we've got the clearinghouse. Now at this point, the client and the dealer do not interact with each other anymore. There's no more negotiating. The contract is locked in. The client and the dealer don't have to ever talk to each other again. It's all done. And now the actual swap happens. So the clearinghouse oversees the swap, but it actually doesn't interact with either party, neither client nor dealer anymore either. Both the client and the dealer need to have margin accounts at institutions that are members of that clearinghouse. And that generally means they've got to have a margin account at some kind of big brokerage or bank. So the client and the dealer each have a margin account at an institution that is a member of the clearinghouse, and it is those institutions that interact with the clearinghouse. So the client and the dealer don't talk to each other. They only talk to their margin account institution. And the margin account institutions don't talk to each other. They only talk to the clearinghouse. So we've got quite a bit of separation at this point between client and dealer. And the institution at which the client has a margin account is responsible for making sure that the client has enough money in that account to cover margin for the swap every single day when the swap is marked to market. And the institution at which the dealer has its margin account has the same responsibility on the other side. And settlement payments are made by the client or the dealer to the institution at which they have their margin account. The money is then sent through the clearinghouse to the institution at which the other party has their margin account, and then the other party can, receive payment from there. And that's how interest rate swaps are performed. Before we talk about how swap clearinghouses work, let's check out why regulations mandate the use of clearinghouses. So many of us remember the financial crisis in 2008. Actually, even though it seems really recent to me, there are people that are 21 years old right now that were 8 years old when Lehman Brothers and Bear Stearns collapsed. And they were huge and old and important institutions. And when they failed, it really frankly scared the hell out of people all over the world. All right, there was a lot of financial panic around that. But as many people also remember, there was another enormous institution that almost failed, but it was bailed out by the US government in order to avoid a truly catastrophic domino effect that might have sent us into a terrible economic depression. And that was AIG, or American International Group. So AIG had written credit default swaps on over $500 billion in assets, and $78 billion of that was on collateralized debt obligations. And these swaps, they sort of act like insurance on those debt obligations. So in this instance, the CDOs were based on commercial mortgages and residential mortgages and home equity loans. And all of those things suffered badly when the housing bubble popped. So basically, if people defaulted on their mortgages, AIG was now responsible for making at least some of those payments. And AIG didn't do much to hedge those contracts, but there were provisions in the contracts that were meant to kind of slow down the calls for payment. Specifically, they tied the calls for collateral in those credit default swaps to AIG's credit rating. So on September 15th, 2008, AIG's credit rating was downgraded below AA minus or AA negative. I don't know how to say it, but it was downgraded below that, and suddenly the amount that it had to pay really just exploded. So in their contracts, once the credit was downgraded that much, all of this stuff happened automatically and all at the same time. So suddenly the amount that AIG was expected to pay for those swaps, it exploded, and the shortfall, it tripled in like 3 days, over $12 billion. And it really, really looked like AIG was going to fail, just like Lehman Brothers and Bear Stearns did. And it was financially, it was terrifying, right? And if AIG had failed, there were billions of dollars. AIG had over $1 trillion under management at the time. And a lot of that was just going to kind of disappear. All right, a lot of money that other financial institutions relied on to survive was just going to kind of disappear. And so the Federal Reserve Bank of New York made AIG an $85 billion loan to keep it afloat. And what we really learned from all of that was that swaps can be dangerous. All right, counterparty risk is very real. And if it is underestimated because the counterparty has like $1 trillion under management, like AIG did, everything can fall down in like an instant. It all happened very, very fast back in 2008. And AIG is really just the most visible or like obvious example of that. But it actually happened with other institutions as well. A lot of banks and insurance companies just got wiped out over the course of a couple of months. So after the financial crisis, new regulations were enacted, which required all swaps to be handled through clearinghouses. And this added a few layers of separation between parties. And now if one party to the swap can't meet its obligations, the clearinghouse and its members are committed to making those payments. And so no single failure can cause that industry-wide chain reaction like AIG almost did. That the clearinghouses will pick up the tab for a counterparty that drops the ball, it really goes a long way toward mitigating counterparty risk. And having a single entity that's involved in a whole bunch of different swap transactions makes those swaps a lot more liquid. Like if one party wants out of the deal, they don't need to go talk to the other party and get them to agree. They just need to get the counterparty to allow them to transfer that commitment to some other entity. And so only the clearinghouse's counterparty risk changes. It's not. It doesn't affect the counterparty, the other party to the swap, nearly as much as it used to. So we call that novation, where you transfer the commitment to another party. It's become a lot easier now that everything's handled through clearinghouses. But the downside to clearinghouses is that swaps are now mark to market daily, meaning that each party is going to need a margin account at a clearinghouse member, and they're going to have to keep a certain amount of capital in that account. And the amount of money that they're required to keep in there is going to change from day to day. So even though the payments and stuff like that don't change, the total cash flows, which includes things like those margins accounts, is different than it used to be. But we are not going to consider margin account cash flows at all in this course. So let's get a better look at how clearinghouses affect swap transactions. So in this swap, there are two parties. Okay, that's A and B, and these two guys have negotiated the terms of the swap. And we've been drawing swaps like this, where there's A and B. I want those to be bigger. We've been drawing swaps like this, where there's A here and B over here. And one leg goes this way and one leg goes this way. We'll say this one is floating and this one is fixed. But really, that's not actually how it works. In reality, there is a clearinghouse in there. And A will make the fixed payment that goes to the clearinghouse via a clearinghouse member institution, and then from the clearinghouse, that fixed payment is then transferred to B through another one of the clearinghouse's member institutions. And at the same time, going the other way, party B makes the floating payment to the clearinghouse through a member institution, and that floating payment is then forwarded to A through another clearinghouse member. Now, those members are typically large financial institutions with, like deep pockets. And in case of a bunch of parties defaulting on their swaps simultaneously, like in 2008, the clearinghouse can call on those member institutions to provide additional capital. So it's kind of like a support system for swap transactions. And when bad things happen, the whole clearinghouse system can bear the brunt of that together, which makes all of the individual institutions much more resilient. So let's just take a quick look at some of the ways that clearinghouses have changed the swap market. So we've got our table here. This is going to be before clearinghouses, and this is now after clearinghouse regulations. So before, everything was negotiated between parties. Absolutely everything negotiated between parties. Now after, many terms are still negotiated. All right, things like notional value, payment frequency, etc. Those are all still negotiated between parties, but some are standardized. And that really helps make everything more liquid. Before, there used to be lots of counterparty risk, all right? And it used to be hard, frankly, to estimate counterparty risk, as we saw in the AIG example from 2008. Even if it seems like such a big institution that there's no way, like it could definitely handle your swap, everything can go wrong really easily, really fast. But now, through the clearinghouses, counterparty risk is heavily mitigated, all right? And the main counterparty risk is actually with the clearinghouse itself. So if anybody is going to stiff you on your swap payments, it's going to be the clearinghouse. And clearinghouses, they tend to be reliable and have massive amounts of capital. So, and since they're really focused on swaps, they don't have to worry as much about all that same stuff that happened with AIG. And since they're made up of member institutions, they don't have to worry as much about all that stuff that happened with AIG. So having clearinghouses, it lowers counterparty risk very, very significantly. And I keep talking about it because that's probably the most important thing about clearinghouses. Now also, before, it was like nearly impossible to oversee the swap market. All right, because every single swap was, just between two parties. They weren't centralized anywhere. So if you were going to oversee the swap market, you'd have to talk to every single institution separately. But now, oversight of clearinghouses is equal to oversight of the swap market. Since all of the swaps have to go through, probably not a huge number of clearinghouses, you can oversee every single swap just by overseeing those clearinghouses. So it makes it much easier for regulators to keep track of what's going on financially. And here is another important point. Before, you can only cancel with agreement from the counterparty. Which was typically very expensive. Because you'd have to trade, the present value of the rest of the cash flows. So that could be, hundreds of millions of dollars, depending on how you've set it up. It can be very, very expensive. But now, novation, which is the transfer of the obligation to another party, is much easier. And only the clearinghouses counterparty risk is affected. And this is also very important. Okay, this is another important one. Novation now is much, much easier than it used to be. So we can see all of these things that we've written down are really net positives for clearinghouses. And I think in most things that I've read, most of the financial industry really thinks that this clearinghouse idea has served interest rate swaps pretty well. As we said right at the beginning, interest rate swaps allow us to change our exposures, often with little to no upfront cost, and that makes them very powerful for risk management. And let's also recall that in a vanilla interest rate swap, fixed interest rate payments are exchanged for payments based on a floating interest rate. So this fixed for floating exchange is an incredible tool for interest rate risk management, and we're going to look at a few different scenarios in which we can use these basic interest rate swaps for exactly that purpose. So let's get into it. All right, let's start with the basic idea of risk management. Basic idea of risk management. And the basic idea is that we want to keep our inflows proportional to our outflows. Now, ideally, the inflows would be greater than the outflows, but as long as we can keep them proportional, we can at least plan ahead, okay? We can at least plan, we can at least know how much we're going to end up paying. So keeping them proportional means that we need to keep the nature of our assets and liabilities the same. And that is, if we have fixed rate liabilities, we really want to have fixed rate assets. And if our cash flows are proportional to some floating interest rate, say LIBOR, for example, then we really want our cash outflows to be proportional to that same floating interest rate. So let's look at an example. We'll say that we are a corporation and we've just had a bond issue, and now we make semi-annual payments to bondholders, and those semi-annual payments will be based on some fixed rate. So right now we have a cash outflow that is fixed, and we will call it C1. And let's say we're worried that interest rates might fall. Or maybe we're not even worried about that. Maybe we just want to keep our outflows and inflows proportional. So let's say we approach a swap dealer and we enter into a vanilla swap where we are paying the floating leg and we are receiving the fixed leg. Now we've got an inflow that is fixed. We'll call it C2. And we've got another outflow that is floating.
and we'll call V1 for variable 1. So now our net cash outflow is equal to V1 plus C1 minus C2. And this whole thing is floating, and it's actually proportional to the floating rate. Which you can see here, it is the floating rate plus some constant. It's absolutely proportional to the floating rate. Now we kind of flip that around and we'll say that we are an investor and we've just bought a bond. And now the bondholder is going to pay us some fixed coupon rate. And for instance, we might be worried that interest rates are going to rise, and we'll be stuck with this fixed interest rate even though interest rates are going up. Or there's actually a lot more that we might go into, and we'll see a little bit more about hedging the value of the bond itself in just a minute. But as an investor, let's say we went over to a swap dealer, and we entered into a swap here where we are paying the fixed leg and receiving the floating leg. So originally, we had an inflow that was fixed, and we'll call C1. And now we've got an outflow that is fixed, and we'll call it C2. And we've got an inflow that is floating, and we'll call V1 for variable 1. So our net cash inflows this time will be equal to V1 plus C1 minus C2. And now this whole thing, our whole net cash inflow, is floating, and it's actually proportional to the floating rate. And again, you can see that what we are receiving, our total net cash inflow, is actually the floating rate plus some constant here. Now we're just going to go a little bit deeper into the same idea from this example, and this is called value hedging. So again, say that we are an investor, but this time instead of a single bond, we're going to have a whole bond portfolio. And our income, our inflow here, is actually going to be the total return from that portfolio. So we have an inflow that is variable, and we're going to call it V1. And we're worried that interest rates might rise, because when interest rates rise, when interest rates go up, bond values go down, which means that our portfolio value, which I'm going to refer to as this fancy P, is also going to go down. So when interest rates go up, the value of our portfolio is going to go down, and maybe we're pretty worried about that. I mean, right now, pretty much globally, interest rates are very low, so there's almost nowhere to go but up. So this is really important to think about right now. So as an investor, we could head over to the swap dealer, and we'll enter into a swap. But this time, we are going to pay the fixed leg, and we're going to receive the floating leg. So what we've made is we've got another outflow that is fixed, C1, and we've got another inflow that is floating, V2. And you might be thinking, well, now we've got different assets and liabilities, like the nature of them isn't the same. We've got floating rate assets and fixed rate liabilities. This is a problem. But we're thinking deeper now. We're not thinking about the cash flows themselves, but how they change with respect to interest rates. So let's look at the total value of this whole setup. Okay? net value of our investments here. So we're getting V1 in from the bond portfolio, and we're getting V2 in from the swap, and we're losing C1 to the swap. But let's look at how it changes with respect to interest rates. So when interest rates go up, the value of the bond portfolio goes down. Okay, so I'm going to call this dv1 di. Okay, this is a calculus sort of notation that means the change in the interest rate over the change in the value of v1 per change in interest rate, usually at a very, very tiny, like infinitesimal level, but it's no problem. So this is going to be negative, which means that as interest rates go up, so as interest rates go up, the bond portfolio value goes down. And over here, we're going to look at the change in V2 as interest rates go up, and that's going to be positive. Because as interest rates go up, we're receiving more money from this floating leg. So as interest rates go up, floating leg payments go up. And that's the whole idea of this kind of hedging, and it's the whole idea behind hedging, like delta hedging. Same general idea is that you're not hedging the cash flows directly, you're hedging the change in cash flows based on some random thing that you can't control. So here the argument is that by entering into this swap, if interest rates go up, our total inflows are going to be affected less than if we had just kept the bond portfolio. And that's value hedging. It's a couple of steps deep and takes a bit of thinking about. But the idea is that we're not controlling the cash flows, we're trying to minimize the change in the cash flows. Next, we'll try some where we're on the other end. In this instance, we're going to be a corporation again. And let's say we have just issued a bond that tells us we have to pay the bondholders a floating rate coupon. So now we've got an outflow that is floating. And we'll call it V1 for variable 1. But of course, we can't really predict what we're going to have to pay here, all right? It's a floating coupon rate. So in order to hedge that risk, we're going to approach a swap dealer and enter into a vanilla interest rate swap where we are going to pay fixed and receive floating. So now we've created an inflow that is floating, which we will call V2, and we've created an outflow that is fixed, which we will call C1. But if V1 and V2 are proportional to some floating rate, say LIBOR, then V2 or V1. V1 is really just equal to V2, which is LIBOR. Okay, per convention, the floating leg is always based on the actual LIBOR rate, the actual floating rate, the actual index rate, plus some constant, which I'm going to call E. All right, so V1 is really just equal to V2 plus some constant E. So now our net outflow is really, well, originally it was V1 plus C1 minus V2. But now, since we can make this replacement here, what we've got is V2 plus E plus C1 minus V2. You can see that the V2s are going to cancel out, and this whole thing right there is fixed. These are both just constants. So we've essentially just exchanged floating rate liability for a fixed rate liability. Cool, right? We've got one more. Let's say that we are an investor and we have purchased a bond from a bond issuer, and we are now receiving a floating coupon rate. Well, in this case, we've got an inflow that is floating, and we can call V1, and we're going to approach a swap dealer here, and we're going to enter into a swap where we are paying floating and receiving fixed. So we've just created an outflow that is floating, and we'll call that V2, and we're now receiving an inflow that is fixed, and we can call C1. Now remember from before that if both V1 and V2 are proportional to LIBOR, and V2 actually is LIBOR, okay, then V1 is really just equal to V2 plus some constant E. So now our total cash flows in, net cash flow in, is going to be equal to that original one, V1, plus our inflow from the swap, which is C1, minus our outflow from the swap, which is V2. But thanks to this relationship up there, we can rewrite that to make it V2 plus some constant E plus C1 minus V2, and once again the V2s are going to cancel out, and we'll end up with C1 plus that constant E. And this whole thing is a fixed rate asset. So we have exchanged a floating rate asset up here for a fixed rate asset down there. And those are really the basics of how we could use vanilla interest rate swaps to hedge some risk and to exchange the nature of our assets and liabilities. Now we've seen how we can use interest rate swaps for risk management, including hedging the value of a bond portfolio. So next we're going to look at hedging interest rate swaps themselves. And as you can imagine, swap dealers need to take hedging their swaps very seriously, with all those floating rates in there, and they've got a few simple ways to do it. And perhaps the easiest way is to just pass that risk along to a third party. So for this, let's say that we are a swap dealer, and we have entered into a vanilla swap here, vanilla interest rate swap with party B. And in this swap, we are paying a floating leg that is based on LIBOR, and we are receiving a fixed leg, which is, say, 1.58%. Now, if LIBOR goes up above 1.58%, then we're going to start losing money, and that's bad. So we're going to enter into another vanilla swap over here with party A, and in this one we are going to receive the floating leg, which is based on LIBOR, and we are going to pay the fixed leg. And the secret is that we are going to charge a slightly higher fixed rate than we pay. So this is called the swap spread, the difference between what the dealer pays and what the dealer receives. and it's typically very small. It's three basis points here, and swap dealing is definitely a volume business. They've got very small spreads. But as you can see here, we are receiving LIBOR and paying LIBOR. So those legs, those two floating legs of the swaps cancel each other out, and we're really just receiving 1.58% and paying 1.55% and making a profit of 3 basis points. Now, I mean, of course, this is a very clean academic example, and real-world swap deals are quite a bit messier, and they involve things like clearinghouse fees and just other stuff. So this is the theoretical idea behind this form of interest rate swap hedge. But let's say we don't have a third party, and we are a swap dealer still, and we've got that same swap as before with party B, where we are paying a floating rate based on LIBOR, and we are receiving a fixed rate of 1.58%. So if we don't have a third party to pass that LIBOR risk along to, then we've really got to come up with some kind of hedge strategy. So remember the idea behind value hedging from the previous chapter, and the same idea applies. Since our liabilities are going to go up as interest rates rise, I'm going to write that down actually. Liabilities go up as interest rates go up. We want assets that go up as interest rates go up. And we really want those assets to be proportional to the floating leg payments. We want them to be based on that same index rate. So let's say that our floating leg is based on 1-year T-bills. When that interest rate goes up, the value of the T-bills themselves would go down. So in order to hedge against rising interest rates, we can actually short T-bills. That way, as interest rates change, the payments on the floating leg of that swap are going to go up, but we're going to have additional profit from falling T-bill prices. A more common example, say the floating leg is LIBOR. We can actually hedge against interest rate rises using euro-dollar futures. Now, euro-dollar futures actually change along with LIBOR. I mean, the forward rate for euro-dollar futures it's really the Chicago Mercantile Exchange's market forecast of the 3-month LIBOR rate. So we can use euro-dollar futures to lock in future LIBOR rates. And these contracts are very effective for hedging interest rate swaps. Finally, we can talk about pricing interest rate swaps. But before we do, we need to mention the difference between pricing a swap and valuing a swap. So in everyday language, pricing and price and value are used interchangeably, but in finance jargon, they mean two very different and specific things. To value a swap would mean to find the present value of each leg of the swap. Then you'd probably take the difference, and that would be how much one party would need to pay the other to end the swap right now. But to price a swap, so remember that the floating rate leg of a swap is usually just set strictly to that floating rate. So to price a swap means to find the fixed interest rate such that the present value of the legs together, present value of the whole swap, is equal to 0. The present value of each leg has to be exactly the same. Now remember, one of the best things about interest rate swaps is that we can have 0 initial cost. So pricing a swap means to calculate the interest rates such that
the initial cost of the swap is 0. Now let's go do it.
The first thing I want us to do together here is work through an example that I found in Paul Wilmot on Quantitative Finance in that book. So this example not only shows how we might find the fixed interest rate for a swap, but it also serves as an example of another reason why we might enter into a swap to begin with. So let's say we've got two corporations, okay? We've got Corporation A and Corporation B, and both of these guys need loans. Now, they're quoted the following rates. They can have a fixed rate. A's fixed rate is 7% versus B's 8.2%. So A's a little bit more creditworthy there. And they're each given floating rates for their loans. And A is asked to pay LIBOR plus 30 basis points, whereas B is asked to pay LIBOR plus 100 basis points. Now A would definitely prefer to do a floating rate loan, and B would definitely prefer to do a fixed rate loan. So if you do the two of them together, so A is going to take the floating loan, and B is going to take the fixed rate loan, then together they're going to pay LIBOR plus 30 basis points is 0.3%, plus B's floating rate of 8.2%. So altogether, they are paying LIBOR plus 8.5%. But let's look at what happens if they do the opposite. If A takes the fixed and B takes the floating. So here we've got A fixed and B floating. Well, then altogether, they're going to pay 7% plus LIBOR plus 1% for the 100 basis points, which is LIBOR plus 8%. So the two of them together, they were able to save 0.5% there. So that is 0.5% of advantage if they do the thing that they don't really want to do, but then they enter into a swap. So we're going to take advantage of this joint advantage, and we're going to make a swap. So A is going to pay 7% for the loan and pay the LIBOR rate to B. B is going to pay LIBOR plus 1% for the loan and pay some fixed rate X% to A. So if we draw that out, we've got A here and we've got B here, and we've got a couple of loan guys here. A is paying fixed rate of 7% for the loan. B is paying a floating rate of LIBOR plus 1%. And then A is paying a floating rate in the swap of LIBOR to B, and B is paying a fixed rate, which we don't know yet. It's X%. And that's what we want to solve for. We want to solve for this. Solve for X. So we're going to look at the cash flows from A's perspective. From A's perspective, okay, he's paying 7% on the loan. I'll come back to that. They're paying 7% on the loan, and they're also paying LIBOR. They are receiving X%, and then there's 0.25% of advantage, and we need that to equal up here LIBOR plus 30 basis points. All right, so for there not to be any arbitrage, this all has to add up to the original floating rate. So that's going to be equal to LIBOR plus 0.3%. Now remember, this is for the loan, this is for the swap, this is their payment from B, and this is their advantage. And this guy here, this is the original floating rate, original quoted floating rate for the loan. So we can use all this, we can solve for x. So if we see very quickly that LIBOR is just going to cancel out, and we'll pair some things together, we'll have 7.25% minus x% is equal to 0.3%. Just a tiny bit of algebra there, and we'll get that x is 6.95%. So now, all things considered, they're making, this is A and this is B, and they're making their payments up here for the loans. Now we've got that A is paying 7% for the loan, B is paying LIBOR plus 1%, A is paying to B LIBOR, and B is paying to A 6.95%. Now let's do the same thing from B's perspective, just to make sure that they are the same. So B is paying LIBOR plus 1%, and that's for the loan. Then he is paying X% for the swap. Then he's receiving LIBOR from A. And remember, there's 0.25% of advantage involved. And that's going to equal the original fixed rate, which is 8.2. Original fixed rate there. And again, we just want to solve for x. You can see that LIBOR is going to cancel out. And so we've got 1.25% plus x% is equal to 8.2%. Subtract that across and we'll get the same answer, x equals 6.95%. So that's one way to kind of find out what that fixed rate ought to be for this specific scenario. It's a great scenario. It really tells you why you might want to enter into a swap. It is for the advantage. Actually, let's go a little bit and let's calculate their total payments. So A is totally paying. So A is paying 7% plus, and he's also paying LIBOR. And A is then receiving 6.95%. So altogether, A is paying LIBOR plus 5 basis points, which is lower than the quoted rate of LIBOR plus 30 basis points. And then B is totally paying, well, B is paying LIBOR plus 100 basis points plus 6.95% and then receiving LIBOR, and all of that adds up to 7.95%, which is lower than the original rate of 8.2%. So this example really shows exactly why you might want to use a swap in this specific scenario, and it shows how to calculate the fixed rate of that swap. Now we used that the advantage was split evenly between them, 0.25% each, but they could also have split it where, you know, A was getting like 40 basis points of advantage and B was only getting 10. But the math is very similar. Remember that pricing a swap means to set the rates on the swap such that the initial value of the swap is 0. So the value of an interest rate swap is the present value of the future cash flows. For a properly priced, 0 initial cost swap, we need the present value of the fixed leg payments to be equal to the present value of the floating leg payments. And when these two present values are the same, the initial costs will balance out, and the total initial cost will be $0. Okay? Now this next part is unintuitive. The floating rate changes over time, and we're not really great at predicting what that rate is going to be. But we actually know everything we need to know in order to find the present value of the floating leg payments. So let's say our floating leg is LIBOR. Okay, our floating rate is LIBOR. So we know the spot rate. We know the spot rate. And we can lock in future rates using forward contracts, euro-dollar forwards or futures. So we know the spot rate, and then we know the forward rates, and we can use those two things to find the present value of the floating leg payments. Okay, so one, we will find the present value of floating leg payments. And then we will find the fixed rate such that the present value of the fixed leg is equal to the present value of the floating leg. There are two ways to calculate these present values, and they should yield interchangeable results. So the first technique is to theoretically decompose the interest rate swap into a package of money market instruments such as bonds. We're going to actually talk about them as bonds. And the second technique is to decompose the interest rate swap into a package of forwards. We're going to do both. Bonds first. The first way that we're going to decompose an interest rate swap is by decomposing it into a package of bonds. Now this is probably the most math-intensive chapter of the course, but it really isn't that difficult. And remember that you can always pause the video, you can rewatch it, you can leave and come back, or whatever you need to do to understand what's going on here. Okay, so considering a financial instrument as if it were a package of bonds is a pretty common way to analyze cash flows and risk involved. So I wouldn't be surprised if we see this again in future courses. Let's start with a vanilla interest rate swap. This entity is B, and this entity over here doesn't really matter. And we're going to have B receiving the floating leg and paying the fixed leg. So Corporation B has a cash inflow that is floating based on some floating interest rate, and it has an outflow that is based on some fixed interest rate. Now let's just draw B with those cash flows. So right here, this is B again. And he's got a cash inflow that is based on a floating rate, and a cash outflow that is based on some fixed rate. And now let's say that the cash flows just come from two separate entities. Say that the inflow comes from being long a floating coupon bond, so this will be the bond issuer over here, and that the fixed outflow is going to a bank, okay? So this is the same cash flows from B's perspective as buying a floating coupon bond and financing that purchase with a fixed rate loan. And And for this to really work, both the bond and the loan have to have the same payment schedules. And so from B's perspective, the cash flows are exactly the same as an interest rate swap, where you can see where B is receiving the floating up here, receiving it down here, paying fixed up here, paying fixed down there. But let's go ahead and draw those cash flows. So this will be our cash flow. This will be our timeline here. And let's see, red is going to be the bond. Blue is going to be the loan. Down will be an outflow and up will be an inflow, okay? So at first, on the very first day, Corporation B is going to receive $150 million from the loan. And they're going to pay that same amount, say $150 million, on the bond. So that actually leaves them with a net $0 on day one. Okay, initial cash outflow, initial cost of this interaction is 0. And then at every point along the way, all the way to the end here, Corporation B is making fixed rate payments on that loan. And they're receiving at every point along the way here. Sorry, I didn't make that one curly enough. They are receiving floating rate payments. And then at the end, they're going to get back their $150 million, okay, from the bond, the par value, and plus some floating payment. Okay, now this was a bond that was priced exactly at par. It's another important step. The bond is priced exactly at par. And again, we need to find, in order to price this, we need to find the fixed rate such that the present value of those fixed payments equals the present value of the floating payments. And some of you might be out there looking at this extra $150 million payment right there, where they're getting the par value of the bond back, and be wondering how that's going to work out. And that's actually really cool. We're going to get to it in a little bit, and we'll see how it kind of goes away. So now, let's look at the fixed rate payments here. Draw a timeline. Whoops, I want that to be black. There we go, timeline, where we're only considering these fixed payments, okay? Fixed payment here. We're going to call them C1. C1, they're paying the same payment every single time, all the way. So that is the same as buying a bunch of, this is out, as paying off, being short a bunch of zero coupon bonds. With, maturity, we're going to call them T1, T2, all the way up to Tn here, where every single one of these zero coupon bonds has that same par value that's coming out at the end, that same final payoff value. So to look at the price of these, well, we'll need R, which is the fixed rate, and that's measured annually, so we'll actually need, I'm going to call it tau here, which is the time between payments. How about, and time between payments. And remember, the all-important day count conventions that go along with this. We're not going to deal with them here, but when you're actually doing this, you need to keep them in mind. And then, we actually need the value of all of those zero coupon bonds, okay? And we're going to say that Z of, we're going to deal with a sum of, we're going to have I equals 1 to N, because T goes from 1 to N, okay, of zero coupon bonds that mature at time ti. So that's the present value of our fixed leg. All right, is r times tau times the sum from I equals 1 to n of z that depends on ti. The secret here is that we don't actually know any of these, except for tau. We don't actually know this. We don't know this guy over there. We're probably not real sure about this one over here. And now we're going to look at the floating rate leg. And we're going to see a really cool trick here. So let's draw us a line. And at first, let's only consider a single payment. Okay? So this is 0. And this is time t, and it's just paying out LIBOR one time. Well, the value of this has to be equal to the value of, this is time 0, and this is that same time as before. We're going to call that big T naught. Why not? Like that. It has to be exactly the same as receiving $1 and LIBOR, and also paying $1. Right? Because the paying $1 and receiving $1 cancels out, those have to be the same value. And if we just look at this top half right here, that top half where you have $1 and LIBOR is actually the same as investing $1 up here. Wrong side. It's actually the same as, it has the same value. Come on, what's going on with my pencil? $1 plus the LIBOR rate in the future is equal, has the same present value as $1 today. And that's the secret here. We're going to go through this whole thing. We're going to start with this first one. Okay, the value of receiving LIBOR at time t naught is equal to the value of receiving $1 plus LIBOR and also paying $1 at time t naught, which is equal to the value of having $1 now and paying $1 later. Okay, that's the secret. Investing $1 now and receiving that $1 back later, having $1 now and paying that $1 later is exactly the same as just receiving LIBOR in the future. So if we look at this on a long-term scale, we're going to have this $1 now, which we can invest, and then over here, we'll pay $1, or we'll receive that $1 back and reinvest it. Then over here, we'll get it back and invest it, and so on both sides up until at the end when we extract that out. And so these two cancel out, and these two cancel out, and it will continue to cancel out all the way to the end. And so what we really have here, the present value of the floating leg, remember everything in the middle is 0, is having $1 now minus the price of a 0 coupon bond that matures at time tn over here. So we've got now, remember we're trying to make the present value of the fixed leg equal to the present value of the floating leg. And we've got that the present value of the fixed leg is this one. So that's r times tau times the sum from I equals 1 to n of 0 coupon bonds maturing at time ti. And that's equal to the present value of the floating leg, which is right here, 1 minus this 0 coupon bond that matures at tn. And we want to know this part. We want to solve for the fixed rate, which is r. So we can solve that. Frankly, we can solve it just by dividing, right? So r is then equal to 1 minus this z of tn over tau times the sum from I equals 1 to n of z of ti. Again, in reality, we don't know any of this stuff. We don't know what these values are. But what we're going to see in just a second is that swaps are so liquid at so many different maturities that we can really price these very easily because the prices actually define the yield curve. So watch out for that in the next video on bootstrapping. Swaps are so liquid at so many different maturities that prices really define the yield curve and not the other way around. Okay, and that allows us to do something ingenious, absolutely phenomenal, that is called bootstrapping. Okay, what this means is that we can actually find fixed rates r of ti, they now depend on ti, okay, for many different ti's, which ti is the time to when that payment is made, the time of maturity for that hypothetical 0 coupon bond. Okay, so we can find those and then use them. Use those fixed rates to price the 0 coupon bonds. So let's write that again. Before we had it written like this, r was equal to 1 minus z that matured at tn over tau times the sum from I equals 1 to n of all of these z ti. But now r is going to depend on time also, so we're going to have r of tj. It's going to equal 1 minus z of tj over tau times the sum from I equals 1 to j z of ti. Alright, all we've done here is now r depends on time. Okay? The maturity date for that payment. So for j equals 1, we'll have r of t1 is equal to 1 minus z of t1 over tau times the sum from I equals 1 to 1. Never mind, we don't need that. This is just z of t1, isn't it? Okay, so we know this now. And we want to find the z. So let's solve that. First we can multiply across tau times z of t1 times r of t1 equals 1 minus z of t1. Add that across. That's tau. I'm going to go ahead and simplify that out. Tau times r of t1 plus 1 z of t1 equals 1. Z of t1 then is 1 over 1 plus tau times r of t1. So now we know this. Now we know z of t1. So now let's look at j equals 2. So we have r of t2 is equal to 1 minus z of t2 over tau times the sum from I equals 1 to 2 z of t sub I, which I'm just going to rewrite the bottom right here. This is tau times z of t1 plus z of t2. And we know this. We know that r again. In fact, the only part of this that we don't know yet is z of t2. So let's solve for that. We have r of t2 times tau times z of t1 plus z of t2 is equal to 1 minus z of t2. We can multiply this part through and get that r of t1 times tau times z of t1 plus r of t1 times tau times z of t2 is equal to 1 minus z of t2. I'm now going to move that z of t2 across and simplify it exactly the same as I did before. I'm just rewriting this first part for completeness, plus, open these parentheses, r of t1 times tau plus 1 times z of t2 is equal to 1. So z of t2 then is equal to 1 minus this part, tau, r of t1 z of t1 over, this should be a 2. So should this. R of t2 should be here. Yeah. Alright, 1 minus tau, r of t2 z of t1, okay, over tau, r of t2 plus 1. And we know everything on this side. So we can calculate this, and we know z of t2 now. So let's just look at j plus 1, given we know everything at time j. Okay, so no matter how many steps there are, 1 all the way through n, you can always get to the next step by doing what we're about to solve for here. So we have r of t sub j plus 1 is equal to 1 minus z of t sub j plus 1 over tau times the sum from I equals 1 to j plus 1 of z of t sub I. And let's multiply that across. Remember, we know this. We can look this up. Basically, because swaps are so liquid, we can always find that rate. And we really want to know this. We want to know this one. We want to know what z of t sub j plus 1 is. Okay? So let's multiply that across. We have r of t sub j plus 1 times tau times the sum here from I equals 1 to j plus 1 z of t sub I. We're going to, oh wait, this is equal to 1 minus z of t sub j plus 1. Now we're going to actually split this into two parts. Okay, so this is actually equal to the sum from I equals 1 to j of z of t sub 1, t sub I, plus z of t sub j plus 1. Okay, so we're splitting that into two parts. So let's write that out. I'm going to put the tau first because I think it's easier for me. So we have tau times r of t sub j plus 1 times the sum from I equals 1 to j of z of t sub I plus tau r t sub j plus 1 times z t sub j plus 1 is equal to 1 minus z t of j plus 1. Now we can move this across like we did last time. So I'm rewriting that first bit. Tau r of t sub j plus 1 times the sum from I equals 1 to j of z of t sub I plus tau r t sub j plus 1, close the parentheses, z of t sub j plus 1, because we moved this over and then simplified it. That's all equal to 1. So then tau times r t sub j plus 1, close parentheses, z of t sub j plus 1 is equal to 1 minus tau r t sub j plus 1 times the sum from I equals 1 to j z of t sub I. And then we can divide by that over there to get that z of t sub j plus 1 is equal to 1 minus tau r t sub j plus 1. The sum from I equals 1 to j of all of the z's of t sub I over tau r t sub j plus 1 plus 1. So we can go through this, use this process, find all of the z of t sub j's, all the way from 1 to n, okay? So we can use bootstrapping to find all the z of t sub I values. Then we can use this, r equals 1 minus z of t sub n over tau I equals 1 to n z of t sub I. Then use this to find the fixed rate r. And that's it. That's called bootstrapping. Great. This was definitely the hardest part mathematically. We're almost done with the course. Really all we've got left to do is talk about swaps as a package of forwards and then look at a few variations. So we've seen how an interest rate swap can be represented as a package of bonds, and hopefully that's given you a good idea of how financial decomposition works. So now we're going to apply the same concept to interest rate swaps again, but instead of bonds, we're going to represent an interest rate swap as a package of forward contracts. So let's start with the same vanilla swap as before. Here's our corporation B. And here's somebody else, and Corporation B is receiving a floating rate, say 6-month LIBOR, and Corporation B is paying a fixed rate, say 10%. So let's draw that cash flow on a timeline. Same idea as before. I don't remember actually. We're going to have red this time be we'll have red this time be an inflow of a floating rate of 6-month LIBOR. And blue here is going to be a fixed payment. This is a single payment of 10%. So if the notional value is, say, $150 million, then essentially B is, this is our trade date, essentially B is buying 6-month LIBOR on a notional value of $150 million. For his payment, which if you calculate it is going to be $7.5 million, deliverable in 6 months. And that is literally a forward contract. It's exactly the same as the idea behind a forward contract. So a fixed rate payer of a swap is really long a forward contract on floating rate payment, and the floating rate payer is short that same forward contract. And in an interest rate swap, the parties agree to enter into the same exact contract in times, a bunch of different times. So very quickly, you might be asking, if they're the same as bonds or forwards, why are we using interest rate swaps at all, right? So there are a few reasons. First, interest rate swaps are incredibly liquid, more liquid probably even than forwards. And swaps can easily have longer maturities than forwards. Forwards typically, it's unusual for forwards to go out more than, say, 10 years. But when we talked about the term of swaps before, I said 100 years wasn't out of the question. 50 years, 30 years, 20 years. These, swaps go on for that long. And perhaps most importantly, in an interest rate swap, a single transaction can do what would take many transactions for bonds or forwards. In this case, in one swap, they're agreeing to enter into the same forward contract I said n times, however many n is. If it's 10 years and semi-annual payments, then that's 20 different forwards, but only one swap. If it's 100 years and monthly payments, that's 1,200 forwards, but only one swap. Okay, a single transaction, a single interest rate swap can do what a whole bunch of transactions for bonds or forwards can do. So it's very convenient, and we cannot forget it is incredibly capital efficient. So now, let's value the floating leg of an interest rate swap by treating it like a package of forwards. So let's say we've got $1 here, and we receive it here, and we reinvest it here, and we receive it here, and we invest it at the same place, and we receive it here, and so on, all the way to the end when we just receive it. And hopefully you remember this exact cash flow diagram from the previous decomposition. All right, the bond decomposition. Now the floating leg of a swap is kind of like rolling the notional value over at the index rate. Okay, we're rolling that over. Instead of $1, this could have been the notional value this whole time. So it's exactly like rolling over that notional value at the interest rate, the floating index rate, over and over and over in times. So we can get the forward rates from the futures market. All right, specifically, we could use the forward rates from like a euro-dollar futures if our floating leg was based on LIBOR. So I'm going to write that down, actually. Get forward rates from futures. All right, pretty much all of the interest rates that you might want to use for the floating leg of a swap is going to have some forward that's related to it. So you should be able to get the forward rates from the futures market. Then, what we'll need is the period forward rate. So for each period, each period I, I'm going to call this PFR sub I, we need the annual forward rate, and we're going to multiply that by tau, which again is the time between payments. And don't forget the day count conventions. And once we've got that period forward rate, we can find the forward discount factor, which is 1 over 1 plus, the period forward rate. These all depend on I sub 1 plus, times 1 over 1 plus the period forward rate 2 times all the way 1 over 1 plus the period forward rate I. And I can go from 1 to n. So really, the forward discount factor for period I is going to be the cumulative product here. 1 over the cumulative product here from I equals 1, from j equals 1, sorry, to I of 1 plus period forward rate sub j. I want to write that out better. 1 over cumulative product from j equals 1 to I of 1 plus the period forward rate sub j. There we go. So if we think about this again, let's go back up here. What we're really doing is we're looking at these payments and we're moving them backward in time. Okay, so this would be multiplying it by 1 over 1 plus the period forward rate sub n. This one here, 1 over 1 plus period forward rate 1, 1 over 1 plus period forward rate 2, and so on all the way up to this one. That's what this forward discount factor does. So now let's look at the present value of the fixed leg payments. Let's draw a line here, and we know that these are fixed rates, so they are the same. Okay, payment here, payment here, payment here, all the way to payment here. And we can actually multiply those back in time by 1 over 1 plus the period forward rate. Get those all the way back here by multiplying them by 1 over 1 plus the period forward rate 1, 1 over 1 plus the period forward rate 2, 1 over 1 plus the period forward rate 3, and so on all the way. So if you look at that, the present value of the fixed leg is equal to this payment times 1 over 1 plus the period forward rate 1 plus this payment times 1 over 1 plus the period forward rate 2 times 1 over 1 plus the period forward rate 1 plus this payment times these three guys up here, and so on. So I'm going to write that. We can pull the payment out. Payment here, 1 over 1 plus period forward rate 1 plus 1 over 1 plus period forward rate 2 times 1 over 1 plus period forward rate 1 all the way to the end. So we're going to write that as the sum from I equals 1 to n of the payment times the cumulative product from j equals 1 to I of 1 over 1 plus the period forward rate j. Okay, which this is actually the same as the sum from I equals 1 to n of the payment times the forward discount factor, forward discount factor at time I from up here. And then we got the present value of the fixed leg. And the payment here, that is the notional value times R, which is the fixed rate. So now we can set the present value of the fixed leg equals the present value of the floating leg. And we'll get that as the notional value times R times that present value, I equals 1, the sum from I equals 1 to n of the product from j equals 1 to I of the forward discount factor sub j. And that has to be equal to the notional value times just the forward discount factor over here. Let's call this k equals 1 to n. of 1 plus the period forward rate sub k, which this whole piece right there is the forward discount factor. I don't know why exactly I wrote it like that. But now we want to solve for r because it's the fixed rate. So hopefully you can see that the notional values are going to cancel out. So what we've got now is r times the sum from I equals 1 to n times the cumulative product from j equals 1 to I of the forward discount factor sub j. And that is equal to the what's the total discount factor? Forward discount factor sub n. The final one. So r then is equal to, if we just divide that across, we'll get that it is equal to the forward discount factor sub n over that sum from I equals 1 to n, cumulative product from j equals 1 to I of forward discount factor sub j. Or you could just call it the present value of the floating leg divided by the notional value times the sum from I equals, you don't need that in there, it's just the forward discount factor. Sum from I equals 1 to n of forward discount factors. So whether we think of interest rate swaps as a package of bonds or as a package of forwards, the most important thing to remember is that we always get the implied forward rates, okay, from the market. Then we use those to discount all of the cash flows back. And once we've got the discount factors for those cash flows, then we can solve for the fixed rate. Okay? So it's always step one, get implied forward rates from the market. Then step two, use those forward rates to discount the cash flows. Then step three is find fixed rate based on the discounted cash flows. There you go. We've gone over two different ways of thinking about how to price interest rate swaps. Up to this point, everything in this course has been about vanilla fixed for floating swaps. Now we're going to look at another common swap wherein both legs are based on a floating interest rate, and this is called a basis swap. The general idea here, or the main purpose of a basis swap, is that we can change which interest rate we're really exposed to, and we're going to see an example of this, especially how we can use a basis swap for risk management when both our assets and our liabilities are based on floating rates, and especially when they're based on different floating rates. So let's go do it. Okay, we are talking about basis swaps. And as we did before, as we said before, this is an interest rate swap where both of the legs are based on a floating rate. So in this case, we're going to say that B is paying A, for example, LIBOR, and A is paying B, for example, the prime rate. Something like that. So these are really useful for controlling which interest rate we're really exposed to, and an easy way to look at risk management using basis swaps is in the context of a mortgage lender. So here we are, we're this mortgage lender. And up here we've got our assets and our liabilities. And the way our business works is we take in money from people who have savings accounts, and we use that money to make mortgage loans. And all of our mortgage loans are based on a floating rate. So our assets are mortgage payments, that come in, and they are based on a floating rate. And in our case, we are basing our floating rate for our interest payments, our mortgage payments on LIBOR. All right, so we've got an inflow that is going to be LIBOR plus some constant, okay, C1. Because nobody actually pays the LIBOR rate, on their mortgage. You pay a spread above the LIBOR rate. And then over here in our liabilities, well, people are making, savings account deposits, which we can use for the mortgage loans because they expect interest in return. So over here, I'm going to say that our liability is savings interest. So that's an outflow, and it is based on a floating rate. And since we're in the US, we're going to say that our savings account rate is based on the 1-year T-bill rate. So now we've got an outflow that is the T-bill rate, plus some constant C2. All right, we are not as trustworthy as the federal government, and we're not going to worry about, FDIC stuff. We're just going to say that we pay a little bit more than the actual T-bill rate on our savings account. Now, the problem is that the spread between LIBOR and the 1-year T-bill rate is not going to be constant. That's our main source of risk. We don't know what that spread is going to be, so we can't really guess at what our cash flows are going to be. So what we're going to do to hedge against that, or to manage that risk, is we're going to approach a swap dealer, and we're going to enter into a basis swap where we are paying a floating rate, say LIBOR, and we are receiving another floating rate, which is the 1-year T-bill. So we've created an outflow now that is LIBOR, and an inflow that is the T-bill rate. So now if we look at our total cash flows here, our net cash flow, we are taking in LIBOR plus C1. We are paying out T-bill plus C2. Then we are paying out LIBOR. Then we are taking in T-bill. So altogether, you can see the LIBORs are going to cancel out and the T-bills are going to cancel out. And we've ended up with C1 minus C2, which in theory is a constant rate. And so by use of a basis swap, we've taken our two floating rate cash flows, all right, our asset and our liability cash flows, and we've transformed them into something that is fixed, a fixed interest rate, a constant cash flow rate. And that's really kind of the big deal about a basis swap, is we couldn't do this using anything else. But what's really happening under the hood here? So what the client sees, from the client perspective, all right, we're really just saying that there's a dealer over here, and there's a client, that's us, and we are paying a floating rate, we're going to call it float 1, and receiving a floating rate, which we're going to call float 2. But what's happening in the dealer's perspective, is actually two swaps. So we've got a dealer over here and the client over here, and there's actually two swaps happening. So there's this one up here, we're going to call this swap 1, and there's this swap down here, and we're going to call this swap 2. And in swap 1, what's happening is the dealer is paying the client a floating rate, float 1, and the client is paying the dealer a fixed rate, fixed 1. And in swap 2, the dealer is paying the client a fixed rate, fixed 2, and the client is paying the dealer a floating rate, float 2. Okay, so it's just like two swaps. A basis swap is like two vanilla swaps at the same time. Now if we go back up here, float 1, we said before, was the T-bill rate, right? And fixed 1 might be something like, to use a number we used before, 1.58%. And then down here, float 2 we said was LIBOR. And fixed 2 might be something like 1.55%. And you can see again here we've got a secret hidden spread for the dealer, where the dealer can kind of build that in there a little bit. And that's how basis swaps work, both from a dealer's perspective and a client perspective, and how we might use one for risk management.
This is the last real section of this super fast course on interest rate swaps, and we're going to use it to talk about a few normal variations on the vanilla interest rate swap. Besides a basis swap, at least. So we're not going to get very deep into any of them, but pricing generally follows the same ideas as a vanilla interest rate swap, where you're going to decompose the swap, you're going to find the present value of the floating leg cash flows, and then find the fixed rate such that the initial cost is 0. That's it. No matter how many variations you make on interest rate swaps, that's the general idea for pricing them. So the first variation, and the only one I really want to use the iPad for, is called an asset swap.
In an asset swap, one leg of the swap is based on the return from an asset or a portfolio. So in this case, say this is a portfolio manager, and over here's the swap dealer. And the portfolio manager is going to pay the swap dealer based on the return from an asset or portfolio. And in exchange, the swap dealer is going to pay the portfolio manager maybe a floating rate, maybe a fixed rate, maybe the return from a different asset or portfolio. Now, the most interesting thing about an asset swap is that returns can be negative. So, up here, if this return is negative, then the swap dealer is actually going to end up paying the portfolio manager. He's going to pay him twice. He's going to pay him both the floating rate or fixed rate, and he's going to make a payment based on the absolute value of the return from that portfolio. Now, in the case that both legs are based on the return from a portfolio, let's draw that out. This is a swap dealer, and over here we've got a portfolio manager, and they're both paying each other return on portfolio. I'm going to call it return A and return B. So if one of them is positive, and one of them is negative, then the cash flows are going to go all from the portfolio manager to the swap dealer. He'll pay the positive here, and he'll pay based on the absolute value down here. Whereas if they're both negative, then they're actually going to They're actually going to swap legs. They're going to change legs. Each of them is going to be paying the other one, but both legs are flowing backward. I think that's very interesting, and to me, this is the most interesting variation on interest rate swaps. And I imagine that the pricing of this kind of swap is much more complicated.
The other common variations on interest rate swaps are mostly about taking something that used to be constant and making it change over time. So first, we'll talk about the notional value. Throughout the course, we've been working with swaps in which the notional value stays the same throughout. But it doesn't really have to. I mean, why should it, right? So in an amortizing swap, the notional value decreases over time, like amortization on a loan. You might want to use this kind of swap specifically for risk management on loan payments, where you're going to pay that loan off, and you know that the principal of the loan is going to go down over the time, so you want the notional value of the swap to go down over time. And the same idea is an accreting swap, where the notional value goes up over time. So you might want to use this for risk management when you have a line of credit and you have a set of expected expenses, and you know that you're going to rack up expenses on that line of credit, and so you want the notional value on the swap to go up as well. And a roller coaster swap is kind of a conjoining of those two. It's one where the notional value goes up and down over time, like a roller coaster. And you might want to use these for risk management when you have both future expenses and you're expecting to pay them off. Like maybe you know that you're going to have some expenses coming up on that line of credit, but then you expect to pay them back down. So you might want the notional value of the swap to go up as your expenses go up and then go back down as you pay it off. Or maybe you're going the other way. Maybe you've already got a loan that you know you're going to pay off, but then you're expecting to have some expenses afterward. Well, then you might want the notional value to go down as you pay off your loan and then back up as you rack up charges on that line of credit. Either way, it's useful to be able to change the notional value. Now, the other two variations we're going to talk about are about changing the term or the tenor of the swap. How long does the swap last for? There are extendable swaps, all right, in which one party has the ability to unilaterally extend the swap. It makes the swap last longer, and it creates future payment obligations for both parties. So say you were using a swap for value hedging, right? So you are hedging the value on a bond portfolio, and you kind of decided that you want to hold onto that bond portfolio longer than you intended. Well, in that case, you might want to be able to extend that swap that you were value hedging with. Or say you were using a swap for risk management when financing a big project, like building an airport. Well, say the project is taking a lot longer than you expected. And so you might want to be able to extend the swap that you're using for risk management there. Now, finally, some swaps are callable or puttable. And that means that one party has the right to end the swap prematurely, and when they end it, one party will pay the other the net value of the swap. So pricing these, it's very similar to pricing an American-style option where one party has the ability to just execute whenever they want. So there's going to be, stochastic calculus and things involved. We're not going to cover that here. But you might want a callable or puttable swap if, say, you're building that airport and you actually finish it a lot faster. Well, then you're probably going to want to, close out all of your financials for the project and just finalize it entirely. So you might want a callable or puttable swap for that. Or maybe you're worried that interest rates are going to change dramatically. And so you really want to be able to just, if the fixed rate and the floating rate get too far off either direction, you might just want to be able to, pay your losses and run. And in that case, you might also want a callable or puttable swap. Now, none of these variations is nearly as common or as liquid as vanilla swaps, but they can be really useful in those specific situations like we talked about. You made it, guys. The course is over. That's all. We covered, the basic idea behind interest rate swaps and how they allow us to exchange exposures in a very capital efficient way, often with no initial cost. We covered how they work in the market, from, negotiation between the parties to clearinghouses to settlement and mark to market. We talked about clearinghouses, about their members and how they reduce counterparty risk. We covered vanilla interest rate swaps in detail, all right, fixed for floating swaps. We covered a few different scenarios where such a swap would be well suited for risk management or even hedging a portfolio, and we decomposed vanilla interest rate swaps into packages of bonds, packages of forwards, and we saw how to price the swap using either of those decompositions. We saw basis swaps, floating for floating, and we showed how they could be used for risk management, especially in the case of a mortgage lender. And we saw that a basis swap is really just two vanilla swaps with the fixed legs hidden. And then lastly, we talked about variations on vanilla swaps. Using asset returns for one of the legs, or adjusting the notional value over time, or extending the term of the swap, or even just cutting the deal short and, ending the contract early. So I hope you learned a lot from this course, and I know I learned a lot making it. Let me know in the comments what you want the next SuperFast course to be about, And if you learned something, go ahead and hit the like button. And if you want to keep learning, go ahead and hit subscribe. We'll see you soon.